Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending March 10th, 2023. And I'm Justin Klein, host of InvestTalk. And this week I'm going to title the video, Second Largest Bank Failure Ever. Is this bear Stearns? So I'll dig into that in just a minute, but I want to start off like I usually do with the overview of the markets, the economic data, and what the Fed's going to do, right? Because that's really the most important thing here over the next couple of weeks is how does the Fed react? Now, you can see the Fed rate probability of a 50 basis point hike right here. This was Thursday. It was at 60%. If you go back to Wednesday, it was at 80%. Now we're at 60%, only a 25% hike, and 40% a 50 basis point hike. I don't think they're going to do that. I think that would be stupid for them to really, in the face of this banking crisis, to add insult to injury. They may go 25. I think there's a good chance that they pause here. So I'll dig into that data here in a little bit. But what I want to start off with is the economic data for the week. You had durable goods orders. The headline was down on Monday, but if you exclude transportation, it was actually up. So pretty good report there. The unemployment claims, that did come in at the highest level since, what are we talking about? December, Christmas, call it. And then non-farm payrolls, that one beats on the top line, or the headline, 311,000 jobs. But if you look under the surface, average hourly workers still is decelerating. Unemployment rate was up. You know, it was really a mixed report, to be honest with you. And I wanted to bring up this here because this is the inflation data. And I saw this. This is really interesting. Is if you look on a 3-month, inflation's dead, right? So minus shelter, because shelter is the most lagging. I've talked about this before because it has a big component of rent, and rent is lagging because people signed leases 8 months ago, 10 months ago, a year ago, and until those leases roll off, and typically landlords don't cut rent, right? And so a lot of those people are moving and finding better opportunities, cheaper prices, rent is falling. And so if you look at it in real time, inflation is pretty much dead, right? You have core less shelter month over month, the last 3 months, 1%, under 1%. So it's saying if you look year over year, it depends on what time frame you want to look 18 months, 2 years, like why is it year over year, right? So if you look shorter term, which is really since the Fed started hiking rates, which I'll show here, the inflation data continues to decelerate. Here is the, where are we? This is consumer prices less shelter index. So this peaked in June. You're down from June. Yeah, you're up pretty significantly from February. But if you look at June, that's not looking very, very hot, right? And then you start looking at the March number, right? March was an acceleration. It's going to start to get those headline numbers are going to come down very quickly on inflation. Okay, so the inflation genie, it's done. It's in the back in the bottle. I think they can, if they're being honest with themselves, that's really what you're looking at, right? Let's shorten this up here. Right, you go here. Yeah. Now inflation's falling, right? So it depends on what time frame you're looking at. Okay. So let's get to the main news, though, and that is here. The death of Silicon Valley Bank Corp., the second largest bank in banking failure in history, behind Lehman. And have had a lot of people ask me the question, what is this? How do you compare this? And I do compare this to Bear Stearns, right? Bear Stearns was kind of the canary in the coal mine of the problems within the banking sector when it came to lending and mortgages and credit. Now, a lot of people look at banks and assets like bonds, and they say credit risk is the biggest is the risk that they focus on, right? You got your customers, the people that are paying on those loans, they can no longer pay. But it ignores another risk. There are other risks, and that is duration risk. We talk about that all the time. When you go buy bonds, you can buy duration, you can buy long-dated bonds, you can buy short-dated bonds, you can buy, and then you have credit risk. You have very safe treasuries, or you can buy, very risky, low grade junk bonds or emerging market bonds, for example, right? Going out in the credit spectrum. So those are the two levers that you can pull. And in 08 was a problem with credit risk. But what happens when you only focus on credit risk and you don't focus on duration risk, you get problems like this. Now, credit risk is a lot harder to solve, right? Because you got to get all of these entities that may not be paying suddenly to start being able to pay again. That's much more difficult. Then the easy fix here is lower rates, right? Let's go over the charts. Here's the 10-year treasury. That's what a lot of these banks have been doing, right? Especially in 2020, 2021, where there's a lot of growth, especially Silicon Valley Bank Corp, a lot of money going into venture capital and tech companies, and that's all reversed. And so they were growing their asset base when rates were very low. They were locking in these 2-3% yields on treasuries and Fannie Mae's, right? Here's Fannie Mae. Here's commercial mortgage-backed securities, right? Falling dramatically. You can go longer-term treasuries, here's TLT falling from 150 all the way down 100, right? That's a 30% drop. Now, what these banks do is they hold their bonds to maturity, and they don't have to recognize them as losses on the balance sheet. They don't have to recognize them as losses on the balance sheet if they're held to maturity. But the problem with Silicon Valley Bank Corp was not only did they have a ton of these kind of low credit risk, high duration risk securities on their balance sheet, but they also had a deposit base that was less than stable, let's just say that, especially in this environment. And so that combination means that when they had to get back into, when they have enough deposits leave, and they're trying to compete with deposits, because you can go buy a 10-year for, was 4%. You can buy a 6-month for 5%, right? People were pulling money out of their accounts there and wanting to chase higher yield, and that's understandable. And this is the main problem with really the rest of the banking sector, is that Silicon Valley Bank Corp had a lot of bad things going for it in this environment. But a lot of the banks have similar bad things, but the deposit base is a lot more stable. But I've talked about this before on the air. If you have treasury, or you have banks still paying 1% when they can go buy, when their depositors can go buy treasuries at 5%, they can go to like Marcus by Goldman Sachs, and they can go get 4%. They can go to Capital One, they can get 4%. Money's going to flow out of the banking system. And eventually there's going to be another bank that needs to sell assets that are being held to maturity that aren't being recognized as losses yet, because they're just going to hold it. And that's fine, right? You don't have a loss for a bond, right? There's those bullet shares. We can probably pull one of those up here. I'll pull one of those up on, let's go to Morningstar. I know there's the bullet, actually we can get here. Bullet shares, okay? We'll go this one, BSCR. Okay. This is decline in value. This is the 2027 corporate bond bullet shares. So all these bonds, they mature in 2027, 4 years from now. So there's not a lot of duration risk, but there's some, right? And you can see the decline in the bonds. We'll go to a weekly here. And you can see that the bonds declined from 22, or this one did, all the way to 19, which isn't a huge loss, right? 10, 15%. But this winds up in 2027, meaning all the bonds mature, and then all the investors get their money back in 2027. So it's kind of like owning an individual bond. And once again, this is fine, because on the bank balance sheets, they might have bought this at 22, but they're holding to maturity, and eventually they'll get back to 2022. You're going to get your yield. And this is how we do it with our clients, right? We ladder bonds, we buy individual bonds. If they're down a little bit, no big deal. We're holding our bonds to maturity. It's rare our clients have to sell those bonds, right? They're living off the income. But in the banking environment where you have deposit base that may be volatile, and in Silicon Valley Bank is very volatile, you might have to go sell those, and you have to recognize those losses, and suddenly you have a hole in your balance sheet, and that's what happened. So the Fed, is this Bear Stearns? Yes, it's Bear Stearns, because if the Fed sits here at, a Fed funds rate, we can go back here, a Fed funds rate at, right now it's 4.5 to 4.50, and then are they going to go to 4.75 and 5? Are they talking about 5% rate, and they do that for very long? Money is going to flow out of the banking system. So what do you do? Simple. Stop raising rates. Lower rates. And in fact, if you go out all the way to December, there are odds, which they're not shown here, that they will actually cut rates by the end of the year. It's low, but it's now showing up once again. So I think we're at the peak in rates. You can see it from the chart, right? This is a good example of what makes sense in this environment. And then the chart is lining up, right? Look at this rally in the 10-year Treasury yield on the weekly, and look at the MACD. This is rolling over. Yields have peaked, people. Unless the Fed wants to blow up the banking system, right? So they're in a tough spot. Generals always fight the last war, and for the Fed, it's still 08, right? Obviously, 2020 really had anything to do with them, but it's a good example, right, where they've put so much money into the system that it caused inflation, and now you're having this problem. So I think they'll be a lot more careful. I don't think they're going to fire hose the economy or the banking system or the financial system with capital. But they're going to pivot in a lot of ways. They pivot back in October, right? October, they saw the issue. They pivoted, the dollar weakened. You can see this with the UP, right? This is the weekly chart. So this peaked back in October. And you had the recent rally, and you're having this problem once again. And let's move over to the MOVE index, right? This has been rallying. This is the COVID spike. Came back down. Everything was fine. And really, since this started to go in an uptrend in earnest, the markets had been rough. And you see this had turned up recently. The Fed's going to have to do something about this. The Fed is going to pivot. I'm calling it in the next couple of weeks. A banking crisis, they know, is nothing to mess with. So should you be worried? Yeah, probably a little bit. But I always focus on what the powers that be have to do. And they have to stem a banking crisis. They don't have to cut off inflation tomorrow, but they do have to stem a banking crisis tomorrow. And I think they're going to take action next week. All right, let's dig into this. The S&P hasn't broken down here. You're actually at some pretty good support, right? This pullback area, consolidation, and we broke out to the upside. So this is actually support area on the S&P. Let's look at NYSE. That one's right at the bottom end of that range, closed above it. So also at support. Let's look at the VIX. We looked at the MOVE index, volatility in the equity space, ticked up a bit above the 200-day moving average, something to certainly watch, but not a whole lot of follow through there, which is interesting. The VIX this is the NASDAQ volatility index. That's still, is that right? Yeah, right below the 100-day moving average. So that didn't really break out either. Something I'm on watch for. Also the dollar. How is this, this in a flight to safety market, the dollar gets a bid, and the fact that this wasn't down more was a bit shocking, but it's going to need to be, right? I talked about this. The dollar needs to weaken. The Fed needs to be done. They've gone too far, too fast. They've broken things. They broke the foreign markets. Now they're breaking the domestic markets, and they have to be done, right? And you can see here, this is SHYG to the SHY. So this is this hasn't completely broken down, right? We're back to those lows from a few weeks ago. Excuse me. But this could break down, could continue to break down. And that would be something I'm on watch for. Does this reverse, or does this start to roll over once again? Gold, that got a nice little bid off this pullback. You know, I talked about this. So this had a pullback. It didn't even get the 100-day moving average. Like this is gold is still an uptrend. Broke out. I expect this to find more gains going forward. Here's silver to gold ratio. That one, this is what I need to get traction, right? This one has had a large pullback, and I need this to get more traction for the gold market to be even more attractive. You have the junior miners to the GDX. That one also needs to get a little bit of traction, but overall, gold technically looks pretty solid. We'll see what kind of follow through we get on Monday. You have the 10-year. That one pulled back here. Once again, yields I think are peaking. I expect that to be in a downtrend relatively soon. ARC also rolling over, big volume today. But what's interesting is if you look at the growth to value, growth still is doing fairly well, and this is actually another, I guess you call it, signal that the Fed is going to pivot. So growth has been outperforming. Obviously, a lot of banks in the value side of the market, so it's not a shocker to see growth outperforming right now. Materials pulling back, certainly into some support. Let's run a fib here. Let's see what that was looking like. Yeah, so we haven't broken. You always in these uptrends, you really like to see 382 retrace being held. So we'll see if that can hold next week. I think it does, especially if the dollar can get more traction to the downside. Energy stocks have been weak as of late, but nothing major here. Let's look at a weekly chart. Yeah, just consolidation, kind of a similar kind of pullback to this 50-day moving average. I'm not too worried about it. You have oversold down here. MACD is showing a bit of weakness, but you're still above the zero line. So I still am constructive on the energy space. Let's look at industrials. Industrials had a big pullback. Look how strong these are, right? 100-day moving average, not a big deal. This is just our trading range consolidation, which I think will eventually move higher. Let's look at the transportation index. Transportation index also pulled back to the 100-day moving average. So you can see a lot of these are still in an uptrend, while the broad indices are below the 100-day moving average at support as well. So you're seeing that divergence between kind of the industrial side of the economy, transportation, industrials, basic materials, energy, kind of the bread and butter industries. They continue to show relative strength. So that's where we're at. We'll see how the Fed reacts next week. I expect something over the weekend, to be honest with you. I just don't see, look at the KBE index. This is not something they want to see, right? And I expect them to react. The Fed always does. They still are fighting '08, and that's why I say everyone else is fighting at '08 too, right? They're worried about credit risk. They're worried about the downside of the market. But what I say is I expect the Fed to err on the side of inflation. Err on the side of inflation. And that's the reaction I'm expecting. If they don't, then I'm wrong, right? But once again, they don't want to blow up the banking system. And so I expect them to have a major pivot. So that's where we're at. We'll check in next week. Sorry for missing the last few weeks. I was on vacation. I'm actually packing to move or buy a house. So it's a lot going on in my world. But glad I could get on here today to really give you my 2 cents of what's happening in the markets, because definitely the most eventful week of the year. Second most eventful week will probably be next week. All right, and we'll check in then. Hope you all have a great weekend. A reminder, the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a good night.